Hello and welcome to this Wednesday's morning market briefing. We've got lots to talk about, but firstly, Eurozone inflation falls more than expected to a figure of 2.9%, as well as China signals tighter Communist Party control of the finance sector, as the Chinese do experience economic doubts. As well as that, we've got lots to talk about on the charts, also with lots happening on the economic calendar. Before we get straight into it, make sure to subscribe. But firstly, to talk about, of course, is the Eurozone. Now, Eurozone inflation fell to 2.9% in October, that being the lowest for more than 2 years. Now, this comes in an act to further. This comes in a way to kind of further those expectations that the ECB, the European Central Bank, will not raise rates any further. This low 2.9% figure is in comparison to the 4.3% figure that we did see in September. Now, this is a significant fall in inflation, and this is coming out of the period of extremely high inflation that we've been seeing across the world, especially in the Western world, with the US and UK and EU economy. Now, the EU were on the lighter side of inflation. However, worries were about the higher energy prices were going to drive inflation higher. That said, it does seem that the fall in energy prices that we have slowly started to see is bringing that headline inflation figure down. Core inflation is another matter, of course, but that nominal 2.9% figure is representing those lower energy prices. Now, as I said, this data does come as a result of those lowering and falling energy prices, as well as low food inflation. This drives a lot of the inflation that we do see, as this is volatile goods. They are very volatile in their prices. Therefore, when there are issues with supplies and demand in relation to those kind of goods and commodities, that is really where we do see that high inflation figures start to form. Now, the data release undershot economists' expectations of an inflation figure of 3.1%. So, on a psychological level, this is a significant decrease, as we have dropped below that 3% threshold. Now, obviously, the main target inflation figure, which many of these main Western central banks do aim for, is that 2% headline figure for inflation. And so now that we've dropped below that 3% figure, it's likely the psychological effect will be great on individuals, economic actors, institutions, and especially the central bank, of course. And I definitely think it will change behaviours within the economy, as we're now out of that 3% zone. When we were above that 3% zone, which we still do see in the US and in the UK, it does feel like inflation is extraordinarily high. Whereas now, even though it still is 0.9% higher than the targeted inflation figure, Eurozone inflation does seem more tame, and therefore less of a thing to worry about, and that's why we could be expecting rates starting to be cut by the central bank now. Now, this begs the question, of course, for the ECB, whether they have done enough to bring down inflation. Now, we've been hearing a lot from the ECB around their monetary policy, with last week them making the decision to keep rates at 4%. Now, President Lagarde did talk about, following that meeting and that decision, that they weren't sure on either cutting or raising rates further. They want to see the effects of rates so far. This is the same rhetoric that we've really been seeing from the Fed as well. And, often it is very hard to see the effects of your own, lifting of borrowing costs. There's so many external factors which are influencing the market, with oil prices being such a significant one most recently, and especially now following the Israeli conflict flaring up. So this is why we have to take all these figures into account with a grain of salt, and kind of expect a response to this figure to actually be seen only maybe 3 months down the line, when they're able to see a greater breadth of historical data in reference to this 2.9% figure. So it definitely is something to note. But that said, last meeting, despite certain rhetoric from Lagarde being quite hawkish. The overall message was seen as quite dovish, as she didn't delve too much into the Israeli effects of, the effects of the Israeli conflict flaring up, which was taken as a dovish kind of message. So definitely keep your eyes on that. And as I said, the ECB did hold the rates at 4% last week, ending its streak of rate rises. Now the Fed is also expected to hold rates where they are today, with the Bank of England expected to do the same tomorrow. So two very significant central bank meetings and policy decisions. So definitely keep your eyes open for that. Now, the decrease in inflation is expected to be somewhat temporary, however, due to the Israeli conflict driving energy prices higher. And this is something we've been talking about a lot recently, just because of the fact that if, the conflict does escalate to a more regional and wider conflict than it currently is, where it's more so just situated in the Israeli recognized territories, then we could expect great effects on the oil supply as a result, as we spoke about yesterday, possibly even driving the price of oil to $150 a barrel. Now, this is a significant, increase in price, and it would be driven by those supply factors, with, the cutting of exports from Saudi Arabia being the greatest risk to a regional escalation, which is why it's so important to keep your eyes on. With the Houthis now, a Shia militia group within Yemen, backed by Iran, now declaring war on Israel as well, saying they were joining the fight. We know they've also sent missiles before, but now they are fully joining the fight, it is believed. The decrease in inflation is expected to be somewhat temporary, as I said. And inflation in the Eurozone does massively range, however, from 7.8% in Slovakia to 1.7% in Belgium. So, significant differences. Now, the lack of growth in the Eurozone has also been a dark side of the now low inflation, as we do know, there are great issues within the manufacturing sectors, especially within Germany, where growth has massively stunted and contracted, even with, the issues with demand being very much a real thing, and the costs within Germany for production going up too much as a result of borrowing costs going up, as a result driving production outside the country. And this is the key issue, is there's two sides to every coin, and when we do have that low inflation figure, we generally will see that low growth as well, due to the fact that to get that low inflation, we have brought up rates to that 4% level in the Eurozone, with the large contrast being with the US economy, which did grow 4.9% last week, being a bright spot in the global economy. Core inflation for the EU fell in line with expectations of 4.2%, down from 4.5%, with the ECB President Lagarde warning wage growth was also critically important to determine the inflation outlook, and she said that last week. Now, stressing the details, this was stressing the details of the next round of wage bargaining agreements with unions. As we know, unions drive increases in wages, with the ECB waiting until 2024 when we will see those bargaining agreements take place to decide on cutting rates. So definitely keep your eyes on that topic for sure. Next to talk about oil is China signalling tighter Communist Party control, with China signalling the tightening of the CCP's control of its $6.1 trillion financial sector industry. Now, we do know, China's economy has stunted, had its issues, especially around its property market. So it's kind of unsurprising that we're now seeing that tightening of regulation and top-down kind of control of the financial sector. With the new warning on weak governance, weak governments and deep-rooted risks within the industry being mentioned at this conference. The two-day Central Financial Work Conference was chaired by President Xi Jinping and saw new searches for a new growth model in response to changing geopolitics and struggles after COVID-19, which, had its effects on lockdowns. Now, this is something that's been troubling China. It obviously has stunted their growth massively, especially with decreased investments from the US as a result of geopolitical tensions and, the kind of issues with its property sector and production in general following lockdown periods. So definitely, that's something to note. Of course, it also saw Xi Jinping, and his allies drive to deleverage China's huge real estate sector, which we do know, massively did affect their property crisis, with focuses on shoring up the finances of local governments. Xi stressed an important part of the country's core competitiveness was the finance industry, making clear risk prevention and control was essential to China's financial industry, with the new CCP-led Central Financial Commission being introduced as a super regulator of the industry as a whole. Now, we do know that years-long anti-corruption crackdowns on China's finances have revealed deep-rooted corruption. We understand this is a key issue within society, with the government calling for more capital to be directed towards technological innovation, advanced manufacturing, and small and medium enterprises. And to tighten the financial regulation, large state-owned financial institutions will likely acquire more market share. So it'd be really interesting to see how this is going to affect markets as a whole, with the government taking up a greater market share of the finance industry. Now, last week, the government announced plans to issue an additional $136 billion in sovereign debt for infrastructure projects and other means to boost investor confidence. And this is part of the overall plan by China to stimulate their economy, as they are in those kind of financial issues at the moment, with Chinese manufacturing contracting in October, putting pressure on policy makers, of course. So this is key to understand, key to note, especially as the Chinese economic issues are coming to light more and more every single day. So definitely keep your eyes on this as the Chinese government does try to respond to these issues. Next to talk about, though, of course, is the charts, with the US indices, of course, being first to highlight. Now, in general, US indices have, consolidated after yesterday. We did see price push up into this area of liquidity that we had noted. Price has seemed to consolidate around these areas. It does seem that US indices and the market factors and the market agents, which are driving price within the markets at the moment, are waiting until the Fed makes its decision on interest rates, and we hear the rhetoric from the Fed, which is the most important part actually. Until we hear that, we really won't see moves on the US indices, possibly hedging moves taking place, but nothing in a significant momentum move. So this is why the Fed's decision today is so important. We obviously have certain areas of liquidity to note for where price can move from, but we are currently sitting around this strong area of liquidity right now. Next to talk about, though, of course, is the dollar, which shoots higher today, largely responding and likely responding to the euro news. It has significantly taken a bullish move, as we did highlight as a potential off this bearish trend line, which has now turned into more of a bullish support for the dollar, as we now do seem to start to form another bullish trend to the upside. It has been very interesting how the dollar's ranged around. We have pushed once again back into this area of liquidity and resistance that we had highlighted before. So it'd be interesting to see now how the dollar does respond to that area, as we have bounced off that significant 6180 Fibonacci level and from that strong area of liquidity and push to the upside. Whether we can now break this strong area of resistance and prior high and move to the Fibonacci extension levels, breaking those record highs, will be the key thing to note following the Fed's interest rate decision today, which will be driving the dollar, of course. Next to talk about, though, is Euro USD, which in response to the headline inflation figure today, which did show that inflation was lower than expected, therefore signalling more dovish action from the ECB. We did see that bearish reaction to that 78.6% Fibonacci area. This has been a highlighted area of liquidity as well. We know there's strong areas of sell orders around this level, and with that 78.6% Fibonacci area, we did have enough confluences to see this bearish move coming. And following that in headline inflation figure, of course, we did see that sell-off in the euro. Now, with the dollar news today, with the Fed making its interest rate decision, this will will really drive whether the Euro USD pair can move further to the downside. If we're looking for that, we want more hawkish kind of rhetoric coming out from the Fed. So do look out for that to see whether the Euro can move lower to possibly this Fibonacci extension level and begin to move in a reversal kind of bearish action. Next to talk about though is pound yen, which has seen such bullish movement today, nearing once again this kind of once bullish trend line. Now has acted as a kind of area of resistance for price as it continues to try and move bullish. It'd be interesting to see now whether price will react to this area. Definitely keep your eyes on that, as we have pushed above this double top, which we did know was a strong area of resistance. That said, we've pushed now into this area of prior accumulation. So definitely keep your eyes on price around that part, as we do know there's been prior resistance here and support and accumulation within this zone. Let's just check whether we have actually reached a Fibonacci extension level. We haven't quite reached that level, so we could be moving higher still, but obviously this area of support has massively pushed pound yen to the upside, so definitely keep your eyes on that. Now USD JPY is obviously something to note, as the yen has seen such volatile moves today, and responding once again to this strong area of liquidity that we highlighted in yesterday's briefing. We did see that bullish reaction to that area as expected, with a significant move once again similar to here to the upside, and breaking even above this Fibonacci extension level, which we had highlighted from this double bottom Fibonacci area. So it'd be interesting to see where USD JPY can go from here. We're not even that overbought on the USD JPY, so we could still have that bullish momentum to the upside. But with such a significant move to the upside, we're undoubtedly surely going to see some form of retracement, and if we certainly do, that's when we can then look for possible re-entries depending on the overall fundamental image, of course. So definitely keep your eyes on that. Next to talk about though is gold, not Bitcoin. Not much has happened with Bitcoin today. We're still ranging around that area, so that's to note, of course. But on gold, more importantly, we have seen gold drop below this bullish kind of short-term trend line and dipping once again into this area of liquidity. It'll be interesting to see now whether this is just a false breakout, and once again we'll return to the upside with that increasing levels of escalation within Gaza and Israel. This fall is likely triggered by the lower inflation data today, signaling dovish action by the ECB. That said, the Fed's decision today and rhetoric around interest rates will be so key in influencing where gold goes from here. But that said, also keep your eyes on any news around Israel and Gaza as we look to see where gold can go from here. Lastly to talk about though is oil, which in response to warmer weather forecasts for this year, we have seen a significant sell-off in oil. That said, we could be moving into really good buy areas if the overall fundamental image still remains bullish, especially in terms of looking at a possible regional escalation, as we do have to remember that with a significant and massive escalation in regional conflict, we could see price run all the way up to 150. So that's definitely something to price in and understand and know, as this would be reaching prices for oil not seen since the night before the beginning of the financial crisis in 2008. So definitely keep your eyes on that. But lastly to talk about, of course, is the economic calendar. We'll get through this quick, but firstly, we have UK's housing prices data as well as manufacturing data, so key information there. As well as that, we have Swiss manufacturing data as well as US mortgage rates. As well as that, we have a small amount of US employment data actually, along with US manufacturing data, which is very key to understanding. And most importantly, of course, we do have the Fed's interest rate decision. This will be driving oil, gold, dollar, Euro USD, USD JPY, you name it, anything paired with the dollar, anything related to the dollar, anything related to the Fed's rhetoric, this will be impacted. So listen out for the rhetoric. We are expecting rates to stay the same at 5.5%. It's very likely that they will just stay at that level. We are possibly expecting a rate hike by the end of this year, and that's why this Fed press conference, and when we hear the rhetoric around whether it's more dovish or hawkish, will be so important. And finally, we have the Bank of Canada's official speech. But that's all to talk about in the charts. That's all to talk about in the economic calendar. That's all to talk about on articles. That's all from us at Wildwood Capital. Have a great one. Have a great trading day. Listen out for the news. See you later. Bye.